We have a long, deep track record of investing in private equity and co-investing with the funds. I personally have been doing it about 20 years in various positions. And as a result of just the length of time, I've met with almost everyone in the asset class, know everyone. And likewise, the other members of the investment team at Caspian also have significant track records and have invested in the asset class for a long time. The other thing is that we're very focused on the North American market. So we're not spreading ourselves too thin. We really have deep expertise on the North American market and know all of the players in it. And then in addition, we're co-investing with the GPs in their deals, and I personally have been co-investing with GPs since 1997. And by co-investing with the GPs, you get deep insights into how they do things, who's the lead, what their angle is, what their competitive advantage is, what value are they bringing to the companies, and that helps you evaluate the funds as well. It's an information advantage that you get in terms of assessing the GP. I think that you can do really well in co-investments, but you can also lose money in co-investments, and the key is having the right approval processes so that you can respond quickly, having the sourcing network, having the relationships within the industry, both with the GPs to get the deals, but also with due diligence sources that can help you analyze the deal. And I think having an experienced senior team is important. Co-investments are not things that can be staffed with junior staff. First of all, I like GPs to be honest and upfront. I like to think that they have an angle. They have a strategy and an angle, and they use that strategy and angle for both sourcing and adding value to the companies and ultimately exiting the underlying companies. As long as the GPs are going in recognizing that they have to have a value creation plan that assumes that they'll exit at a lower multiple and they have to grow and build the company in order to survive the downturn, I'm comfortable with putting money out in today's market. What we're trying to do is focus on why the GP wants to raise this fund size that they're raising. Do they have the proper staff to deploy that number of deals, that amount of capital? Is the market they're targeting sufficiently large to warrant the fund size? And do we have confidence that they can scale their firm the way they expect to scale their underlying company? A lot of times we meet with GPs that have actually underlying companies have done well. They have attractive gross IRRs on their, or multiples on their underlying companies. But then when you benchmark them, they're third or fourth quartile. And the reason for that may be that either they didn't deploy the full fund, so there was a fee drag, or they took a long time to deploy the fund, and while they were charging management fees on fully committed capital, they only deployed a little for a long period of time. And the ways they can compensate for these things are, number one, if they had a voluntary European waterfall instead of American, that helps with the time value of money and the IRR. If they recycle their capital, if they get an amendment from their LPs so that they can use up to 100% of the fund and before they raise their next fund, there are ways that they can work on managing the gross net spread so that they can improve their benchmark ranking. To the LPs in our portfolio that have well-established portfolios, we're adding sector-focused funds and mid-market funds, operational turnaround funds. For a newer LP that's just building a program, it makes sense to start with a core base of some diversified funds before you start adding sector-focused funds.